property investment.
Hi, Assalamualaikum. My name is Siti Husnina Farzana binti Hasan from class TPM 6B. In this video, we will talk about property investment. So, you must be wondering what is property investment. So, without further ado, let's jump to the meaning of the property investment first. Property investment is an investment on land, which is a real estate investment purchase with the intent of earning a return on the money used to purchase the property. Property investment involves the purchase, ownership, management, rental, residences, or sale of real estate for profit. The return on the investment can be earned through rental income on the property, again on the sale of the property, or both. The investment can be made by an individual, a group of investors, or a corporation, or some other type of organized entity. A property investment can be a long-term or short-term investment. With the latter, investors will often engage in flipping, where the real estate is bought, remodeled, or renovated and sold at a profit within a short time frame.
Pillars of property investment.
The first pillar is location.
Your location should be near a job. Tenants and end buyers must have steady jobs in order to rent or to buy a houses.
The second pillar is terms.
Terms are the tools with which you buy or control and then make money off of the real estate.
Last but not least is expandability.
Expandability of real estate can make you get an extra profit.
Hai, Assalamualaikum warahmatullahi wabarakatuh. My name is Fatihah and Zulaiqha binti Abdullah from class TPM 6B. Now, I will continue my part. I will talk about types of property investment. There are 5 types of property investment. The first one is residential investment. Residential investments are investment into residential title properties such as terrace houses, apartments, condominiums, single-family homes, townhomes, or the other types of properties that come with residential land titles. An investor who purchases a residential property and rents it out to tenants can collect monthly rents. Okay, number 2 is commercial investment. Income-generating properties don't always have to be residential. Some investors, especially corporations, purchase commercial properties that are used specifically for business purpose. Commercial titles properties are for business usage, which the units are typically leased out for company or small business owner. The properties in this category such as office buildings, small office versatile office, small office flexible office, shop lots, and retail. Number 3 is retail investments. When we speak about retail property investment, they are similar to commercial property investment, but with different prime location. The retail properties here are located in malls and others retail storefront. Number 4 is industrial investment. Industrial real estate investment are investments from industrial warehouses to firm as distribution centers over long-term agreements and to storage units and other various special purpose that generates unique levels of income from rental or resale. Industrial real estate investment often have a significant fee and service revenue streams to increase the return on investments for the owner. Nevertheless, it is very niche market and requires specialized professionals how to maintain and to manage it, as well as a bigger upfront capital investment. Industrial property investment are generally considered to be more risky as compared to residential and commercial property investment. Okay, number 5 is REITs investment. A REIT, a real estate investment trust, is a company that owns, operates, or finances real estate. Real estate investment trusts own different kinds of income, producing real estate such as shopping malls, hotels, office buildings, apartments, resorts, self-storage facilities, and even cell phone towers. Investing through REITs means you are buying shares of a corporation that owns real estate properties that distribute its income as a dividend. Okay, for example, if you want to own a hotel, you can invest in hotel REITs. But you have to remember that you do not actually own the property. You only have a little or no decision-making power on how the property is to be run and managed. Okay, the last one is IREITs. IREITs is a Sharia-compliant investment. IREITs means Islamic Real Estate Investment Trust. In general, an Islamic REIT is a collective investment scheme in real estate which the tenant only run permissible activities based on Sharia principle.
Alright, I will continue on my part is the 5 risks that we should be aware of before entering the property market. First is house prices are impacted by complex factors. Location is a key component of this. The buyers must look for a comfortable and strategic home, provided when 50% of respondents put locations such as workplace and children's schools as among the main options for buying a house. It can reduce travel time, easy and comfortable life where now the demand price decrease while the supply price is increased. Second is outlook change from year to year, which means the price for investing in real estate investments can change according to the economic situation of the country. Next, rental returns can be tricky. Rental return is an important part of the equation when it comes to assessing the financial viability of many property investments. Finding tenants is one particular challenge, and you should factor in the risk of a period zero rental return on your cash flow. Number 4, loan values impact your economics, which means if you will taken out an interest variable loans to purchase property, you used to be aware of the risk that the repayments on that loan could increase above the return you gain on your property. Always consider the potential for interest rates to change when calculating the economics of taking out a loan to purchase a property. Lastly, is your capital is tied up. When we issue capital to buy any unit, we will not continue to get a return on capital or profit in the near future. The reason for this investment here is a long-term type of investment. We must want to sell our asset when the value of our asset increase, right? So the meaning here is that you can't sell at will anytime. We have to wait until the market conditions for the value of the asset increase before we can sell.
Hi, Assalamualaikum. My name is Siti Solehah binti Hamizan from class TPM 6B. So today, I will share with you what are some of the common mistakes made in property investment. Firstly, not doing enough research. Doing research is a limit to finding information on one specific property only. You also need to have a good understanding of the market. You can gain valuable insights by doing on-the-ground research. For example, going to a property you are interested in and talking to the neighbors that can give you a glimpse of how it's like living there. So being physically will allows you to look the overall conditions of the property. Next, not having a constraint plan. Most investors expect a high return on investment, but they don't know how to plan for it. So, you need to know your investment goals and come up with contingency plans. One of the most important rules is to never invest money you can afford to lose. So then, you will not lose all your money when the market is in your favor. Next, making irrational decisions. These decisions are made without studying the facts and relevant information, which is making decisions that are emotionally driven. Real estate investors often fall prey to greed and anxiety. The greedy investors sometimes people have a lot of money in the bank, so they have realized that property investing is where they're meant to be, and they are becoming motivated by it. So they are looking to buy anything frankly. That's not what you should be doing, but you should find a really good property, then do the deal. While the anxiety investors will sell their property when the market is down. But some investors also buy properties based solely on gut feeling or the advice of friends. So you have to look for other factors as well to buy for investment, logical reasons, than emotion. Next, overconfidence. This mostly happens to long-term investors because they assume they know the properties market well. One way to curb this is to have a goal-centric approach. When you have a goal, this can help to keep you focused, assume of the market condition. To prevent this, you can start asking yourself, what source of information do you rely on when you make a decision? Are they facts? Do you rely on hunches? When you're asking this to yourself, that will bring you close to your goal. Otherwise, you may also include constantly reviewing and evaluating your investment strategies, or having a person you trust to keep you on track with your investment plan. And the last one is not knowing your investment objective before you're investing. That are you looking for cash flow today? Are you looking for long-term capital growth? Are you looking for a mixture of both? So you need to decide what your investment objectives are before buying investment property, and you then look for properties that align with that investment objectives.
Hi, my name is Miral binti Mohammed. I am from DPM 6B. Now I would like to brief you guys about advantages and disadvantages of investment property. Like any investment, there are pros and cons to investing in real estate, in addition to the potential for significant profits. As a result, due diligence is very important whether you do everything yourself or use industry experts to help. Okay, now let's jump into advantages of property investment.
First one is added income.
Where the income is more certain because you receive constant rental payments from the tenants. In the case that the rental income is higher than the mortgage repayment, you no need to put extra funds to pay off the loans, and you may also have surplus funds to cover any property costs incurred.
The second point is tangible assets.
Where having an asset that you can see and touch creates a comforting feeling that you have bought something solid and stable. Besides, there's limited supply of land while the demand for it continues to increase, so it's advisable to grab a piece of it.
Next point is capital growth.
If your property increase in value, you will get benefit from a capital gain when you sell.
The last point is tax deductions.
Because of your property investment, you will get to enjoy the tax deductions for rental expenses and other expense deductions, mortgage insurance.
Now, let's look for disadvantages of property investment.
The first point is low liquidity.
Selling a property isn't easy, and you just cannot immediately get a deal for your property and get it sold for cash.
The second point is maintenance.
The owner is liable to pay maintenance cost of the property.
Next point is possible liability.
You will have non-performing asset in your hands if you bought property in a poor location, especially when you're facing financial hardship.
The last point is problematic tenants.
It's best to prepare for the worst by having additional funds for your maintenance costs because it's rare to have rude tenants that will cause havoc to your property.